Never put all your eggs in one basket. This old saying is the foundation of diversification, one of the most important principles in investing.
Diversification helps reduce risk by spreading your investments across different types of assets, regions, and time. Let's begin with diversification by asset type. This means not relying on a single investment, such as only stocks or only real estate.
By mixing different assets, you can balance risk and potential returns. For example, combining stocks and bonds allows you to capture growth while maintaining stability.
Stocks offer higher potential returns, but their prices can fluctuate daily. Bonds are generally safer, providing steady income and cushioning your portfolio against stock market swings.
Adding real estate can provide another layer of diversification. Rental income and property appreciation are often uncorrelated with stock market performance, which means your real estate investments may grow even if the stock market declines.
For many investors, including ETFs or index funds can further simplify diversification. An ETF holding hundreds of companies spreads risk automatically.
Even if one company underperforms, others in the fund may compensate. When building a diversified portfolio, think about allocating your money across multiple asset types to reduce the impact of a single underperforming investment. For instance, a beginner might consider a split like 50% stocks, 30% bonds, and 20% real estate or ETFs. The exact allocation depends on your goals, timeline, and risk tolerance. Diversification does not eliminate risk entirely, but it helps control it. By spreading your investments, you reduce the chance of losing a large portion of your portfolio from a single event or market swing. A practical tip for beginners is to start small. Even with $100 or $1,000, you can diversify.
For example, invest $500 in a diversified stock ETF, $300 in bonds, and $200 in an REIT. This simple mix gives exposure to different asset types without overcomplicating your portfolio.
Remember, the goal is balance. You want to grow your money while minimizing unnecessary risk.
Each asset contributes differently. Stocks drive growth, bonds provide stability, and real estate adds income potential and diversification outside traditional markets. By understanding how different asset classes behave and interact, you can make informed decisions about where to place your money.
Diversification is not about avoiding risk entirely. It's about managing risk intelligently. Finally, think about your personal comfort with risk.
Even a well-diversified portfolio may fluctuate in value. The key is to build a mix that aligns with your financial goals and allows you to sleep well at night, knowing your investments are structured wisely.
Spread your investments wisely.
Diversification is not just about different asset types. Another key principle is diversification by region.
Investing in multiple countries or regions helps protect your portfolio from economic downturns in a single market.
For example, if you only invest in the stock market of one country, your portfolio is highly sensitive to that country's economy, politics, and regulations.
By spreading investments across different regions, such as North America, Europe, and Asia, you reduce this concentration risk.
If one region's economy slows down, other regions may continue to perform well, balancing your overall returns.
One practical way to achieve regional diversification is through international ETFs or index funds. These funds include companies from multiple countries, automatically giving you geographic exposure without the need to research each market individually. Real estate investments can also be diversified geographically, though this is often more accessible through international REITs or funds rather than direct property ownership in another country. The second dimension of diversification is time, often implemented through a strategy called dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. Instead of investing a lump sum all at once, you spread your investment over weeks, months, or even years. Dollar cost averaging has two main benefits. First, it reduces the risk of investing a large amount right before a market downturn. Second, it allows you to buy more shares when prices are low and fewer shares when prices are high, effectively lowering your average cost per share over time. Let's illustrate with a simple example. Suppose you have $1,000 to invest. Instead of investing the full amount in one day, You decide to invest $100 every month for 10 months. During this period, market prices fluctuate. Some months you buy at higher prices, some at lower. Over time, your average cost per share smooths out, and you avoid the stress of trying to perfectly time the market.
Combining regional diversification with dollar cost averaging creates a powerful framework.
You are spreading risk across both geography and time, which helps reduce volatility while maintaining the potential for long-term growth. For beginners, even small, consistent investments can grow significantly over years. The key is discipline and consistency. You don't need to perfectly pick the best country or the exact market timing. Following a diversified plan and investing regularly is more important than trying to predict short-term market movements. In summary, diversification works in multiple dimensions, by asset type, by region, and over time.
Each layer reduces different kinds of risk, helping you build a more resilient portfolio.
The goal is not to eliminate risk entirely. That's impossible, but to control it in a way that aligns with your financial goals.
Remember, the more you diversify, the smoother your journey tends to be, and the more confident you can feel about long-term growth.
Combining asset diversification, regional exposure, and dollar cost averaging creates a solid foundation for any investor, beginner or experienced.
Now that we've covered the main principles of diversification, by assets, by region, and over time, let's look at a practical example to bring these ideas to life.
Imagine a beginner investor with $1,000 to start building a portfolio. Instead of putting all the money into a single stock, they can diversify in several ways.
First, they might allocate 50% to a diversified stock ETF, which includes hundreds of companies across various sectors. This provides broad exposure to the stock market while reducing the risk of any single company's performance affecting the portfolio too much. Next, they could allocate 30% to bonds, offering stability and predictable income. Bonds act as a cushion during periods of market volatility, helping to balance the ups and downs of stocks. Then, they might invest 10% in a REIT or real estate fund, giving exposure to real estate without needing to buy a property directly.
This adds another layer of diversification, as real estate often behaves differently from stocks and bonds. Finally, they could allocate 10% to an international ETF. This provides regional diversification, spreading investments across different countries and reducing reliance on any single economy. By diversifying geographically, the portfolio is better protected against local economic downturns.
This small portfolio already demonstrates key principles: diversification by asset type and region.
To add time-based diversification, the investor could use dollar cost averaging. For instance, instead of investing the $1,000 all at once, they could invest $100 each month over 10 months. This approach reduces the risk of investing a large sum right before a market drop and smooths out the average purchase price over time. Even with just $1,000, this strategy provides exposure to multiple asset types, markets, and timeframes.
Over the years, these investments can grow significantly while the risks are better controlled compared to a single, concentrated investment.
Now let's summarize the key takeaways. Diversification is essential. Spreading your investments across assets, regions, and time reduces risk.
Asset allocation matters. A mix of stocks, bonds, real estate, and ETFs balances growth and stability.
Regional diversification protects your portfolio. Investing in multiple countries reduces dependence on one economy.
Dollar cost averaging helps control timing risk. Consistent investments over time reduce the impact of market fluctuations.
Start small and be consistent. Even modest investments can grow substantially when diversified properly.
Remember, risk cannot be completely eliminated, but it can be controlled. The goal is not to avoid risk entirely, but to make it predictable and manageable. Diversification is the most powerful tool for achieving this. Finally, keep in mind that the best portfolio is the one that fits your personal goals, timeline, and comfort with risk. Every investor is unique, and your strategy should reflect your circumstances. By combining the principles of asset, regional, and time diversification, you can build a resilient portfolio that grows steadily while helping you stay confident in your financial journey. Investing is not about luck. It's about planning, consistency, and smart risk management. Start early, diversify wisely, and control your risk to create a portfolio that supports your long-term financial goals.